Friday, September 11th, 2020, Maneco 64, home of alternative economics and contrarian views. We're going to look at today how the fractional reserve banking, central banking monopoly system, and also the national debt system backed by taxes from the general public increases inequality, creates a system where the people in charge of the system, the bankers of course, benefit greatly from doing very little, while those who do real things in the real world lose out even more. And yeah, right now I would say we are pretty much at the height of this system. And before I look into it and go over it briefly, as I see it, I just wanted to say that even the central bankers, some of them who have retired, are calling or questioning the fractional reserve system. One example, Mervyn King, the governor of the Bank of England during the '08 crisis, in his book here entitled The End of Alchemy, Money, Banking, and the Future of the Global Economy. So I'll turn to page 261, where he talks about this subject in the section entitled More Radical Reforms. So let's go through what Mervyn King says. Frenetic activity among the official community cannot conceal the fact that although much useful repair to the fabric of regulation has been made, nothing fundamental has changed. The alchemy of our banking system remains. So this is after the '08 crisis. He wrote this book after that, of course. Since the bank bailouts in most advanced economies were huge, it is surprising that more has not been done since the crisis to address the fundamental problem. The scale of central bank lending to a relatively small number of financial institutions was so large that one could have paraphrased Winston Churchill by saying that never in the field of financial endeavor had so much been owed by so few to so many, and with so little radical reform. Of course, governments, financial regulators, and central banks are all well aware of the nature of the problem, but official efforts to tackle it are in stark contrast with more radical ideas proposed, albeit never implemented by earlier generations of economists. Well, the reason why they haven't done anything about it is because the bankers who benefit from this system, they've kind of taken over policy making, the banking lobby, of course, right? They've that's really a euphemism for buying out the politicians. I mean, you look at Barack Obama when he came to power. One of his major advisors was a guy from Citibank. You look at Donald Trump. He's got Mnuchin. He's got Wilbur Ross, who worked for the Rothschilds, right? So he's got Larry Kudlow, who used to work for the New York Fed and is a Wall Street shill, right? So let's continue. Even though the degree of alchemy of the banking system was much less 50 or more years ago than it is today, it is interesting that many of the most distinguished economists of the first half of the 20th century believed in forcing banks to hold sufficient liquid assets as reserves to back 100% of their deposits. They recommended ending the system of fractional reserve banking, under which banks create deposits to finance risky lending and so have insufficient safe cash reserves to back their deposits. The elimination of fractional reserve banking was a proposal put forward in 1933 as the Chicago Plan. So I'm going to end it right there. He talks about how, of course, fractional reserve makes lending risky, but he doesn't talk about the iniquity of the system. And I'll tell you how unfair it is. Very simple example. Let's say a banker has $100 on deposit. Someone deposits $100 with the banker. That banker lends out $1,000. He multiplies that out of thin air, right? He creates another 900 out of thin air, and he charges a 3% interest on that $1,000. So he's going to get $30 every year from that. But in reality, he's getting 30%, right? Because the original deposit, on the back of which he lent that $1,000, was $100. So now let's look at a farmer. A farmer, let's say, has $100 worth of capital, i.e. the farm, all the equipment, and that farmer needs to work really hard 24/7, 365 to earn 4%, let's say, on that $100 or $4 a year. I guess you can multiply that. Of course, a farm is not worth only $100, but it gives you the idea. So over the years, you get the bankers earning this 30% really on $100, while people in the real world, it doesn't just have to be farmers, they have to do real work to get a return. And on top of that, you have the derivatives these days, which are actually more fractional reserve banking, so to speak, because the banker could take also that $1,000, which he or she leveraged off the $100 and put it in the futures market and leverage it even more, maybe 20 times. That's how the inequality has grown over the years. So what does this fractional reserve banking, central banking, the national debt and taxes have to do with each other? Well, I've covered this before. I've done a series of videos about this book here, Paper Against Gold, containing the history and mystery of the Bank of England, the funds, the debt, the lowering and the raising of the value of paper money by William Cobbett. And I'll put the videos I did about this up in the cards and also in the description, so you can listen to the video and see what I mean exactly. But basically what he said was that prior to 1692, in England, because there was no UK at the time, the UK only came a little later, there was no national debt. So if the monarch wanted to wage war, the monarch would borrow money from the bankers, and the monarch would have to pay the bankers back. They couldn't really borrow infinitely and put it on the back of the public, right, through taxes, because there'd be a revolt. But what happened in 1692, just before the Bank of England was created 2 years later, William and Mary actually borrowed £1 million from the bankers. And 2 years later, of course, the Bank of England was created. And even one of the founders of the Bank of England, William Paterson, said that the bank had the exorbitant privilege, so to speak, to receive interest on funds that it created out of thin air. So that's how it all started. And it also made the Bank of England, of course, it gave the Bank of England the monopoly of lending money to the government, and it gave the system a lot of credibility. So they started out with £1 million in 1692, and now we're up to I think 2 trillion, right? 2 trillion pounds. And all the of course backing for this is the taxpayer. And they use excuses like, oh, we have to provide people with a welfare state. We have to fight these wars that are an existential threat to the nation, right? They always have a major crisis to justify all the borrowing by the government. And then they come out like they're coming out now here and saying, oh, you know, we're going to have to raise taxes. People are going to have to pay for this, even though we didn't ask for any of this, right? And on top of it, these funds that are lent to the governments through the bankers don't really have to work to earn that those funds. They just write it on the ledger. They create it out of thin air. So that's how the mechanism of fractional reserve banking, central banking, which gives the hybrid power of the state and the central banking system, has over time created all the inequality and all the misery that we've seen over the years. One would expect in the 21st century that we would have worked out a system where money is really a utility and it serves the general public. I'm not saying everyone's going to be equal, but it's going to be a fairer system. Even Judy Shelton, who's President Trump's nominee for the Federal Reserve Board, said that the system has become a casino, that money should really be a tool for the general public. It's ironic that someone like that would want to join the Federal Reserve Board, because the Federal Reserve is part of the problem. But maybe to phase out this system, one needs to do it from within. Who knows? And it looks like she's going to have a tough time getting on the board. I see there's a lot of opposition to that. So what would you rather do with $100? Lend it out to different people and be able to lend out 1,000 and get 30 afterwards from leveraging that and staying at home. And then if your loans fail, right, the government and the central bank will come and bail you out and keep you going? Or would you rather go take that £100 and do something that productive, that creates value, but you can't leverage out of thin air? So that's where the world is. That's why this system is unsustainable. And that's why they've had to keep interest rates so low, because we've come to a juncture that the debt is so huge that unless they do that, it's all going to collapse. So before I finish, of course, let's quickly look at where the markets are this morning. It's 8:27 a.m. London time. Yesterday, stock market came back down, still very choppy up there. The technical picture doesn't look great. The weekly technical picture for the major indices don't look very good. The Dow yesterday lost 405. S&P lost just under 60 points, and the NASDAQ lost 2%. Right now, we've got gold and silver are still consolidating. They looked like they were going to break out yesterday, but came off late in the day as the stock market came down as well. Right now, gold is at $19.42, down about $4. Range has been $19.37 to $19.50. Silver is at $26.75, down 10 cents. The range has been $27 to $26.55. The Dow futures up 238. The S&P futures up 34, so about 1% higher. NASDAQ 100 is up 171, 1.5%. The currencies, we saw the pound drop sharply, continue to drop sharply yesterday. It is rebounding a little bit today. We're at 128.54, up about 0.4%. The euro is at 118.43, up 0.25%. Dollar yen is unchanged at 106.20. WTI crude up slightly at 37.55. The 10-year yield is at 0.69, so up slightly from yesterday when I spoke. Still hovering around that 0.65 to 0.7 area right now. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.